everyone, Andrew Thompson here from JBWere's Investment Strategy Group. Well, 2017's dream run for investors has become somewhat of a distant memory, with 2018 delivering regular volatility and another good-sized sell-off in October, which saw US equities fall around about 10% between the 3rd and the 29th, before finding their feet into the end of the month. Now this highlights the two contrasting years we've had. 2017 saw global equities deliver returns of more than 20%, with only 3 days where markets fell by more than 1%. Now contrast this with 2018, where we've seen this combination of return without much risk be completely flipped, with returns close to flat for the year and around about 25 days of markets falling by more than 1%. However, when we combine these 2 years together, the result's nothing particularly out of the ordinary. Together, both years have delivered returns to investors of around about 12% per annum, and we've had a couple of sell-offs along the way. And this is broadly what we'd expect from equity markets. The October sell-off also looks relatively run-of-the-mill to us, with it being the 18th sell-off we've had in the almost decade-long bull market, and the average size of these sell-offs has been about 9%, a little over 9%. Now the key message here is that even in good market conditions, investors can expect 1 or 2 sell-offs per year. So the big question from us, as always, is October just another what we'd call bull market correction, or is there something more sinister bubbling beneath the surface? We see this as a reset of expectations given the environment we're in, rather than the beginning of something deeper. And there are a couple of reasons for this. Firstly, recession risk remains low in the US, and that's underpinned by strong economic growth. The market is also now pricing in what we consider to be a more realistic path of rate hikes from the Fed, which leaves less scope for an interest rate shock for investors. The US housing market and corporate sector are broadly in good shape, and alongside that, a full-blown trade war looks less likely to us, given the positive developments we've seen this year around NAFTA and the ongoing negotiations between the US and Europe, and the US and Japan. However, the big one still remains China, and on that note, we are hopeful of some sort of positive development that comes out of the meeting we expect to happen between Presidents Trump and Xi at the G20 at the end of November. But it's something we'll obviously be watching very closely. US midterm elections last week delivered broadly an expected outcome to us. We expected the House of Representatives to flip to the Democrats, and the Republicans gained a couple of extra seats in the Senate. So from our perspective, really this just represents a removal of a key source of uncertainty into year end. A divided Congress will likely make President Trump's legislative agenda more difficult for the next couple of years. But at the same time, in our view, the Democrats will probably want to be seen to be working closely with the Republicans on certain matters to take a more positive message into the presidential elections in 2020. Now, just finally, before I finish, we're nearly through third quarter earnings season in the US, and it's been another really good earnings season with earnings growth of more than 25%. So it's better than we expected, and even slightly better than the first couple of quarters this year. Now, revenue growth has also been around about 12%, so that's very strong, and really shows that the earnings picture in the US is not just about tax cuts, that there is good momentum underneath the surface in corporate America as well. So I'll finish there, but as always, please get in touch with your JBWere advisor if you've got any questions or require any clarifications. Thanks.